Gold is staging a really nice recovery, but it's kind of put to shame recently compared to its younger cousin, or actually I don't know about younger, but it's less traded, less popular cousin, silver. Silver launch padding to new, fresh, all-time trading highs. Congratulations to the silver bulls out there. And we're also going to take a look in today's video at the stock market. Is this recovery that we've started to see sustainable, or is it one big old fat bull trap, like I've been seeing a lot of commenters say on my channel here recently? Is this a bull trap? Is it time to actually get out of the way of this market? And are we going to crash lower from here? I definitely have my thoughts on that, but it also seems like as we come into December, we've got to take a look at the US dollar because the Fed is likely cutting interest rates in December. Is that a worrisome thing? Are they worried about something in the jobs market? Or is this sort of business as usual and could be a tailwind to risk assets? Regardless of whether it's a tailwind in the sense of a risk on or risk off move, seems to be favorable for precious metals, which is where I wanted to start today's video. Let's talk a little bit about price action first and foremost when we take a look at gold. By the way, if you want to skip ahead to another assets that I'll be talking about in today's video, feel free to do so. I'll be taking a look at stocks. I'll be taking a look at the dollar. I'll look at currencies, commodities, etc. Feel free to skip ahead if you prefer. Okay, so let's take a look first and foremost at gold. So if I take a look, I'm going to actually bring it back to the monthly time frame. The monthly time frame has actually reached, I saw something kind of interesting, probably the most, well, actually, yes, I believe this is correct. I believe the monthly time frame on gold has reached the most quote unquote overbought, and I say that kind of begrudgingly with a little bit of cringe, the most overbought status that we have ever seen on the RSI for gold here recently. At least that's on the standard RSI, the 14 period, I imagine. I've got the 4 period here down here. But point being, I've seen a lot of posts here recently of people claiming that gold is actually in a bubble and that everybody's talking about the AI bubble, but gold is actually in a bubble. That seems to be another popular theme on social media right now. I'll give you my thoughts on it and why I don't think gold is in a bubble and why I think gold deserves to continue to move higher in the bigger picture. Now, I'm not saying that we shouldn't have a pullback. In fact, if we take a look at the monthly time frame, it does look pretty stretched. I think that's fair to say. But that doesn't mean that we have to start selling off tomorrow. In fact, I wouldn't be surprised if we got more stretched before we did have some sort of more sustained pullback. I thought we were going to get a more sustained pullback, but that did not seemingly happen. You can actually see if we take a look at the moving averages, we sort of corrected, right? You had this down move for a little bit of time, then we kind of went sideways, and we actually even retested the 20-day moving average, but we never even retested the 50. However, I think you're going to. I think you are going to test the retest the 50 period moving average, if not right away, maybe down the line. But I think that that is still very likely to happen. However, it could be much higher than where it currently sits today. And I think that that is sort of what correction in time means. When you get a sideways, bigger picture move in a precious metal like gold, what that's really doing is it's letting your moving averages pull up and kind of catch up to price. And I think that that is likely going to happen over the course of the next several months. I don't think you're likely to see this kind of move again unless something is seriously wrong in the financial markets. But it does look like we are likely to get interest rate cuts. This has put some softness on the US dollar here recently, which is helping the precious metal gold silver. Of course, this area of resistance, when we look at the 100 level, that big psychological point seems to be holding for now for sellers. I think that sellers get more constructive if you can actually take out the lows here. And when we're talking about gold, we do want to keep an eye on the US dollar, as of course, it can be a tailwind or a headwind for precious metals, what is going on with the US dollar. So let's go back to gold here from a price action perspective. What I like here is that we were able to hold that 20 period moving average. We did ultimately hold that area of support, which is right around when I bought. After the hold of this area, I decided, okay, I'm going to stick with this trade. If it breaks that support and that 20 period moving average, I'm going to cut the trade. Still haven't moved my stop further from there. I'm still just going to let this one run if it wants to. I think personally that gold should have a potential catch-up move to silver. I mean, this is a really nice move for silver, really impressive breakout to all-time highs, and I wouldn't be surprised if gold is likely to follow. However, there's some hurdles that we got to get through first. This 4,200 level of resistance looking left is where we want to see price get up and above going into this week. So if you're a precious metals bull, that is something to look out for. Technicals look bullish. I think if we take a look at the daily, weekly time frame, we have, generally speaking, a nice, visible, obvious upward trend. Are we a little stretched? Sure. Maybe that causes a little bit of some sort of pullback here in between or continue to see consolidation. However, I am not a believer that just because something is stretched to the upside that it must come down immediately. In fact, people are calling this thing overbought, but you know what they're not calling it? They're not calling the US dollar, and I'm getting this from a post I saw. They're not calling the US dollar overprinted, right? Not overpowered. I mean, it is a powerful currency, but they're not calling it overprinted, right? They're printing a ton of currency. That is arguably one of the number one reasons why gold would go up over time is more fiat currency getting printed. Instead, people are calling it overbought. And I still do kind of subscribe longer term. I've been a precious metal bull for a very long time. I think that when it comes to the bigger picture, they keep printing fiat currency. They're not going to stop anytime soon. National debts around the world are massive. Fed's cutting interest rates, global central banks cutting interest rates. This is a big picture that I think you just don't want to fight, and I personally remain bullish. Now, I do also want to just mention, as always in all of my videos, this is not financial advice. I'm here sharing my thoughts and opinions. The reason I'm disclaiming this now is because in this video, I show you trades that I'm looking to take or ideas that I'm taking, but I have a system and I've traded for 10 years at this point. I've done a lot of homework on this stuff. I've really learned a lot, only to realize that a lot of the gurus that you see online who try and tell you, how easy it is to make money, they're full of it. And in reality, good trading is like flipping a coin with a 55% probability. You're not going to win every time. In fact, you're going to have a lot of calls that are completely wrong. But over the long stretch, you'll do okay if you manage risk and don't blow up along the way. So personally, that is my approach to financial markets. Slow and steady truly does win the race. Otherwise, I would have left this race a long time ago if I wasn't risking properly, because everyone has losing streaks and drawdowns. With that said, that's my opinion on gold. I think gold, precious metals can continue higher. Part of the reason we have top setups here giving us this confirmation, gold is getting a bullish rating within EdgeFinder, a +6 score. Remember that over 5, if the score is 5 or greater, we get a bullish reading on the EdgeFinder. Now, to come up with this score that we're talking about, this score here, the +6, the EdgeFinder looks at a collection of sentiment readings, technical readings, and economic data. We can actually get more granular. I think it's just visually a little easier for the video to keep it in the top setup simple window, but we can actually take a look at the overview of the top setups page within EdgeFinder to see specifically what precious metals are doing. So let's take a look at metals. And if we just take a look at gold here, what we can do is let's just go to gold and we can add silver here. What we can see is we're getting a +6 reading for gold and a +5 reading for silver. COT and retail positioning are giving us a mixed reading, so no strong readings there. Seasonally, it's a strong period of time going into December for gold and for silver. Trend is to the upside. That is pretty obvious as we discussed. Technically, GDP statistics were strong. That is weak for gold. Manufacturing PMIs were weak. That is strong for gold, right? Remember, weaker economies, weaker currency, that's better for gold. Services PMIs were strong, not so great. Retail sales, good for gold. CPI, good for gold, etc., etc. That's our overview for gold and silver. We're getting a nice reading overall and continue to remain bullish, backed not just by technicals, but also by macro and sentiment. That is how we do all of the trade ideas that I share on my channel. I am not a strictly, purely technical trader, although there are traders who do great with that. I found a lot more confirmation, confluence, and quite frankly, much better trading setups through the use of macro fundamentals and sentiment aligned with me in my trading. And if you're not an EdgeFinder user, don't miss your chance. Our Black Friday sale, we extended it through this weekend for people who need a chance to get funds together to take advantage of our lowest price of the year. I will be leaving all of the information you need down below in the description of this video if you want to explore the EdgeFinder deals that we are offering. Again, it is 40% off. Also, if you're not a member of our VIP group, consider joining this as well. I share every trade that I'm taking in real time. So if that's something that you're interested in seeing, you can get access to my trades, all the entries, exits. There's my pretty face. You got Marco's trades, Ivan. We also have Chris Pulver in the group as well. So if you're interested in trading with us, highly, highly recommended you take advantage of the discounts that we are currently offering. I'll leave these linked in the description down below. If you already have Edge Finder, consider joining us in the Discord as well. It's a great way to actually see the Edge Finder in use as well in real trade examples that are being taken on real live accounts backed by verified trading results as well. And I think that that is very key in the trading space, that whoever you choose to purchase from actually has some stats to back it up. I do my best on my channel. If you go to my homepage, you can always see videos that I've done on my personal trading performance. So like I said, all information for the Black Friday discount on our VIP group or the Edge Finder or the stock box can be found in the description down below. Let's move on now to a little bit closer of a look at the US dollar. We discussed it briefly in combination with gold, but let's take a look from a technical basis first. From a monthly time frame perspective, remember that the very long term, when we actually apply some moving averages, still kind of tentatively favors the upside for the dollar index. We've had a period of time where dollar dominance has kind of been the thing, bigger picture. But if we drop down to the weekly time frame, we kind of see that we've had this more of a slow decline here in the US dollar in recent times. However, the question starts to become, from just a kind of recency weekly time frame basis, we can see things have really actually been kind of quiet in comparison to how loud they really were early in 2025. Right, in 2025, we had a lot of worries about the trade dynamics that were going on with the Trump administration. That has settled down, at least for now. We'll see if that flares up once more. We traded in a range for most of 2023 to 2024. We finally had a little bit of a breakout that ultimately faded and completely erased those gains. Dollar index over the longer stretch, I really have a bit of a neutral bias, at least for now. I think long term, I'm sorry, let me re-say that. In the here and now, I'm pretty neutral on the dollar. In the longer term, I actually still kind of favor dollar upside. And I'll give an explanation as to why that is. In terms of like growth, right? Growth in the US does seem to be outpacing, or it is outpacing rival kind of central or major Western powers, right? So, for example, growth, we can actually look at this. I did this in yesterday's video, but I'll do it again here. If you take a look at like GDP growth in the US, GDP growth 3.8%, pretty strong. By the way, it's forecasted by the Atlanta GDP now to be at 4.2% for the current quarter. That's pretty remarkable GDP growth, especially when you compare it to other places. If we look at Europe, very small nominal growth here. If you take a look at like Australia, 0.6%, still not as good as the US, down for New Zealand. If you take a look at Germany, or if you take a look at UK, right, you can see there's just not the impressive growth that the US very clearly and visibly has. Over the longer term, that does have implications for the currency, because higher growth typically leads to the less need over the bigger time horizon to cut interest rates. Inflation is still kind of sticky here in the US, although not as bad as it is in other places, like, for example, the UK. Although they did have a little downtick in inflation, I didn't see that, 3.6%. That is, of course, a nice, refreshing feeling for the UK, which has had pretty much nothing but upside in inflation growth here recently, which is painful for citizens, as prices of goods going up can hurt, especially if people are not getting wage increases at the same pace or greater. Anyways, if we take a look at the US dollar, where am I at with it? Well, let's take a look at the US economic heat map real quick and just see what things are looking like here. So USD impact is actually getting a pretty strong overall reading. Specifically, we had non-farm payrolls that came in better than expected. That's bullish for the dollar. ADP also came in better than expected. That's bullish for the dollar. JOLTS better than expected. Jobless claims better than expected. So you can see that on the jobs market, we've actually had a little bit of an uptick data point here recently that looks promising. Unemployment rate did tick up, however. That's not so good for the US dollar. Wage growth, 3.8%. That has been better than expected here. That's strong for the US dollar, as it puts more cash in the hands of the consumer. If we take a look at PCE, mixed, as it came in line with expectations. Same thing with PPI. CPI actually came in lower than expected. That's bearish for the US dollar. Why? Well, because this being less than expected gives a slightly more room for the Federal Reserve to consider cutting interest rates. They're worried about the jobs market. They're also worried about inflation. Right now, they are more poised, it seems, towards the jobs market. Retail sales came in soft, however. This is bearish for the dollar. Less consumer spending shows maybe a little bit of weakness in the consumer out there. Services PMIs came in better than expected. That's a forward-looking indicator of growth. That's good. Manufacturing also forward-looking, but not so good for the U.S. dollar here. It was weaker than expected. GDP, as we just discussed, much better than expected. Overall, most things look okay for the U.S. dollar. I think that remains bullish. However, when we're trading currencies, you can't just look at one currency. You have to look at the rival currencies to decipher whether or not a currency is bullish or bearish. You can't just look at the US dollar and say, okay, the US dollar looks good, I'm going to sell everything else. Well, what if other places have stronger readings? So we have a tool for this. It's called the Economic Surprise Meter with an Edge Finder. And we can see which currencies are actually getting weaker readings, which ones are getting stronger readings. And so right now, economically, in terms of outperformance or underperformance relative to expectations, the UK and the euro actually look pretty weak. I currently have a small short position on the pound US dollar. Let's pull that up here really quick and we take a look at that. So pound US dollar, I sold this rally here recently with willingness to actually add into this. If we get some further movements higher, I actually think there's some good value in some potential shorts. I'm going to remain on the short side here. Would not be surprised if the pound dollar does sort of do one of these moves here in coming months. I think that the pound has some struggle, and we can take a look specifically at the UK economic heat map to build a basis here. It's rough in terms of a lot of the economic data here. This is part of the reason why I'm short. Fundamentally, I really like the macro outlook here with I dislike the macro outlook for the UK. I like the setup. GDP growth was softer than expected, right? Came in lower than forecast, which was 0%. Manufacturing PMIs beat, services PMIs missed, retail sales missed, CPI still sticky, but just at 3.6% as expected. So we'll call that neutral. PPI came in hot. Unemployment rate came in at 5%, ticking into a new handle, that 5 handle, higher than expected. So overall, little bit of softness here for the UK economy. And so I think that they're dealing with sticky inflation, low growth. That is a tough circumstance, and it makes me a little bit more on the bearish side of the pound. Now, as always, I don't know that the pound is going to go lower against the US dollar. Something could change in this, and we could start moving higher. That is why when I take positions on anything, it is a small position. I don't take huge all-in bets ever because we never know with certainty what's going to happen next. I think most likely the pound dollar is going to move lower, but I don't know that for certain. Anybody who claims they do know for certain or they told you so on a move actually is kind of showing their ignorance. No one knows for certain about what is market's going to happen next, right? If somebody is saying, matter of fact, oh, I told you I knew it was going to do this or I knew it was going to do that, there's a good chance they don't actually know what they're talking about, because good traders know, as I said earlier, it's like a 55% coin flip. You're not going to be right all the time, and saying, quote unquote, I told you so implies you think you have a much greater percentage chance of being correct in the markets, when in reality, if you do enough back testing, you will realize that if you have something like a 55 to 60% correct ratio, somewhere in that range, you are doing exceptionally well. And it is actually the people that think they're much better than that who are certainly much worse than that. Whereas people who have the humility to say, I'm going to take this slow and steady, and realize that it is very difficult to call market direction. It sounds easy, right? It is actually quite difficult to do so on a consistent basis over the long stretch. Anyways, that being said, good traders recognize that also market conditions change, right? So if you're saying I'm always right on gold because I've had a 100% win rate in the last year, well, there's a good chance you've just been long, right? But what happens if you continue that same strategy and then you go into a period like this where your strategy says buy every little dip, and then every little dip here just turned into a bigger dip, right? My point with showing you this is that everyone is sort of a genius when their strategy is working really well, but when you become a professional in this game, you realize that everything, every strategy, every person, every content creator has losing streaks and drawdowns, and their system looks completely stupid at times. Once you accept that, you you were awakened as a trader. You realize, okay, it's just a game of probabilities and I just need a slight edge and I need risk management to keep me safe. And I'm just going to grind along this road for a long time. And eventually that compounding effect will make you very successful in trading if you truly have the right recipe for success. Small risk per trade to survive inevitable nasty drawdowns that will hit you, like they do everyone, me, you, every single person is going to hit with losing streaks and drawdowns. And at the same time, you have a system that actually has an edge. You're building confluence, you're building setups that actually win over many, many repeated iterations, but you very well recognize that you could be wrong on the next trade, the trade after that, and 10 trades to follow. You could have a 10 trade losing streak. It is very possible. In fact, I talked about this in a video I recently did on my channel. In fact, if you have a few minutes, I would recommend that if you have not checked out the video that I'm referencing, this is the one right here. If you go back in my videos in my YouTube channel, check this one out. This is the real secret to profitable trading. This video is probably one of the best ones that I've made all year long. It's a really, really critical topic about exactly what we just discussed. Essentially, in this video, I prove that even if you are profitable and have a very good system, it is guaranteed with a big fat G, a guaranteed probability that you're going to have losing streaks that exceed your expectations. They're very much a part of trading. Everyone has losing streaks and drawdowns. The only people who trade and actually make it, I'm trying to say this as clear English as I can. What you think is a normal drawdown will likely get tested almost certainly in your trading eventually. If you are not prepared for it, it doesn't matter what you do between now and then. You'll blow up and destroy your entire account then. Watch this video. Please take a few minutes. I think it will help you if you're someone who is still kind of figuring out the ropes, or if you're someone who's recently found trading success, or you think you have, right? One of the most devastating, painful kind of market coming to get you feelings is that you start to have success in markets only to have a terrible losing streak come along and destroy all of your results. This video just might help you avoid that, and it is something I wish I watched many years ago. Enjoy it, and I hope it's helpful. So a bit of an update on a position that I am in. I'm still in this NASDAQ long position. We ultimately held beautifully right there at this area of support we've been talking about on the channel, the October 10th low. Put in sort of an ugly equal low here, right? We came down, just wicked slightly below. Fortunately, I was able to stay in the trade, and we have pretty much rocketed back. And then in terms of a level that we talked about quite a few times on the channel, we talked about this level here. In fact, let me show that a little bit more clear with our yellow line. So check this out. We talked about this quite a bit. I talked about it many times last week and going into this week. This idea that this left shoulder, right shoulder potential for the bears was kind of your last line of defense. We also mentioned that this lined up pretty well with our Fibonacci retracement tool, right around the 50 to 61.8% retracement. I mentioned if the bears are going to hold it, my educated guess would be that you would see some sort of hold from the bears along this yellow line in this range. We just, at least for now, crossed above and closed above the 61.8% retracement. And if you've been listening along with my videos, then you may know where I'm going with this. I mentioned that I think that if we closed above, there is a good chance that we continue to march right on back to all-time highs. Now, let me also be open-minded to what could potentially derail that line of thinking here for me on the NASDAQ. Now, I think, like I said, path of least resistance, we look very constructively bullish. We held support. The 100-day simple moving average also held beautifully as support for us. I think bulls are in charge of this market. I think they have been. I think they continue to be. I've had a lot of people bearish on the markets commenting on my videos recently, and it's not coincidental because, again, we've talked about this quite a few times. Its sentiment is very bearish. It's been in the dumpster, and this is probably the most hated bull market I've ever seen in my trading career. Shockingly, usually when you have the market moving up like this, people start to get really bullish, euphoric, and it seems like everyone is convinced it's going to go melting up into the sunset. Shockingly, that's not the case in this rally. This market is incredibly hated. It is the popular thing to hate this market. Let me express that through data. Now, again, if you're a bear, let me just open your eyes to something. Because if you're bearish and you have a logical trade plan, I'm not angry at you at all. But there's a lot of illogical bears out there that I need to kind of talk to, okay? Being bearish on an uptrend, a bull market, is probably one of the biggest lessons learned for many new traders or people who believe that doomsday is right around the corner. And it's not your fault if you are a doomsday, concerned person. What I mean by that is if you think the stock market's going to crash, if you think everything's going to fall apart, people have been saying that for literally like almost 2 decades. Since the financial crisis, we have seen countless figures in popular financial media be made very popularized because being a doomsday person gets people's attention. And we as humans want to look for the big problem that nobody else is seeing. It's like ingrained in our nature to want to see the market crash coming before it happens. And that very nature fools so many people into completely missing out on what has been a remarkable move in markets. Now, I am not saying that this thing is just going to melt up forever and that bears are permanently idiotic for being bearish. There is a time and a place to be cautious on markets, but price action looks strong. Corporate earnings look strong. There's an old adage, don't fight the Fed. The Fed is on our side, the bull side. They're cutting interest rates. They're supporting the market through quantitative easing, right? That seems to be on the come up. Corporate earnings being high have also spurred in a period of massive spending from corporate earnings. We have to look at the facts, and we also have to look at sentiment. One of the strongholds for being a bear is I'm going to be bearish when no one else is left being bearish, right? That sometimes actually has been some of the times that have been very profitably bearish, right? 2008, nobody ever thought the market was going to crash. Guess what people think right now? Everyone thinks the market's going to crash. It is the popular crowd that thinks more people are responding to this AAII investor sentiment survey that the market's going to crash than people think, or not necessarily that the market's going to crash. People are pessimistic on the market, and they have been this entire year. Let me show you. If we expand this out to May of this year, right around the bottom of this market, we saw sentiment completely super bearish, okay? Above historical averages, we saw high levels of bearishness. Again, 45%, people responding incredibly bearish. Actually, sorry, let me go back to April because April was the low. If we look at the low, look at this. 62% of people, 62% on the week before the market bottomed and started ripping higher and has ripped since, people were outright bearish on this market. I'm telling you this because bubbles typically happen when everybody is convinced that they cannot crash. When everybody thinks the market's going to crash and price action is trending higher against them, that is called a good old-fashioned short squeeze. And the people who have been stuck on the sidelines forcing into the market at higher prices, causing the melt up to continue. I want to not come across as arrogant. I know I know I'm sounding very, very, confident that this market, I think, can continue. But let me express something. We could crash at any time. Calling crashes is one of the most common traps in new trader experiences. What I mean by that is that we always want to call the top. But what's been so much harder than it looks to do is to do just that, to call the top. In fact, buying dips with constructive risk management, acknowledging where we could be wrong, has been outright a dominant strategy in recent years. At some point, let me acknowledge something. That won't be as good of a strategy. Buying dips works until it doesn't. I acknowledge that, and I'm not a fool to think that the market will go up like this forever. I've made a lot of money buying dips constructively with risk management in focus. I know that won't work forever. I also know that I will look for certain indicators to tell me that something is changing in the market. But currently, we just don't have it. When I look at the U.S. economic heat map, and again, this is my approach. You might look at markets differently. I'm not saying my system is the only way to look at it. But stock market sentiment here, stock market impact here on the economic data looks very good. You still have non-farm payrolls that held up. What happened to the bears who were like, hey, stock market's going to crash because the labor market's horrendous. When the government shutdown lifts, we're going to see some horribly red numbers that are going to send us into a plummeting recession. Look, it can happen at any time. At any time, the market could crash. And what will happen, I'm telling you now because it happens every time, once the market's down, bears who have never said anything will come out on the YouTube channel and say, see, I told you so. I actually did that here recently. Let me tell you this. When this market was selling off right around this time, somebody commented on my YouTube video. And as the creator, I can actually see past comments from a user. Well, this person only commented on my channel a couple times. They commented over here saying that the market was going to crash. They commented over here, the market was going to crash. During this time, they commented like crazy. Isn't it interesting how that psychologically works? Now, again, this is the problem with being bearish, is if you are bearish, that there's nothing wrong with being bearish. There's a problem with being bearish when there's not actually a logical reason to be bearish. If you're trying to be contrarian as a bearish person, right? We just showed you contrarian sentiment right now is more likely to be bullish than it is to be bearish if we're going off of the AAII sentiment survey. However, let me push back on my own point here. Put call ratio, at least as of the recent few days, we have seen a surge in bullishness that I can show you once this thing loads. There it is. We have seen a surge in bullishness. So my point is more kind of poised to the recent weeks where we've seen a lot of bearishness in the options market. But at least in recent days, we have seen a surge in call option volume. So I think actually, this is not really a point at this current level where I'm deploying new money into the markets. My strategy relies heavily on looking for price action pullbacks in a predominant upward trend. But fundamentally, I still like the story. And let me express that if something changes to get us to actually break through these moving averages, these key level supports, and the macro starts to slip, I am not a perma bull. I'm just a bull when conditions favor it. And it just so happens that bulls have had a very convincing argument, in my view, for the last few years, and that has absolutely been the correct call. I've been able to outperform substantially in the last few years because I have maintained bullish and buying dips because I still see the economy as sound enough to continue to bolster this AI trade for the time being. At some point, there will be a time to jump ship. When it happens, I will personally share, if I think it is time, on my YouTube channel. Whether I'm right or wrong, only time will tell. I've made many right and wrong calls on my YouTube channel. I would never tell you that I'm always correct because that is foolish, as we discussed earlier in this video. But in my perspective, the NASDAQ is a dip buying opportunity until proven otherwise. As always, if I do buy a dip, it's not all in, bet the farm, and blow up if otherwise. I'm not using leverage. I'm not using margin. I am simply looking for constructive pullbacks. And if the macro continues to favor it, if the sentiment data continues to favor it, and we get a top setup reading with it, it is how I trade. I use this day in, day out. My system is not overcomplicated. We keep stuff in these three buckets: economic data, technical reads, and sentiment. I'm not going to short the market just because I missed out on the rally. Unfortunately, a lot of people have been making that mistake. A lot of people have, they made a mistake in April. A lot of people, unfortunately, also let politics completely derail their trading strategy, as people under Biden did as well. This is not a Trump thing. This is unfortunately, a thing that many traders do. Many people during the 2022 market sell-off, we had a pretty good reset in the NASDAQ. I mean, at this point, or during this period of time, you had a 38% drawdown in the NASDAQ. It was nasty out there. And people were commenting like crazy. Biden's going to send us into hyperinflation. He's going to ruin everything. And I'm going to short this market. And I'm, not buying stocks. The administration's idiotic, right? Whatever. And the market ripped. And then people did it again under Trump. People said, oh, he's going to ruin us. Everything's going to go to HE double hockey sticks. And the market ripped. It's not a Trump or Biden thing. It's not a Republican or Democrat thing. It's unfortunately a thing where people sometimes make really emotional decisions with their financial, market trading. And I think it's something that you can learn from. So if you did make that mistake, move on from it, learn from it, but don't make it again. Again, getting caught up in politics is a quick way to tank your trading performance, in my personal opinion. So, with that said, guys, like I said earlier, don't miss your chance. Pick up a copy of Edge Finder if you don't have it. Start trading with the data. Ignore the news headlines, the scary headlines, the political jargon, all that stuff, and start trading what the data is actually showing us, not what your doomsday feed on Twitter or scary YouTubers talking about the end of the market crash, etc. Keep that stuff out of your feed. I'm telling you, it's actually probably worse for you than good. Doomsday, and if you do, last thing I'll say on this, if you do watch some doomsdayers, right, some of the perma bears, right, perma bears, balance it out. If you watch some perma bears, mix in some people who are bullish. Hear context from both sides. I think that's probably one of the better things to do. Like, obviously on my channel, I lean bullish recently, but I ultimately will shape shift into a bear if the market conditions truly change. But I just don't have that reason to be bearish at this time. So, like I said, get yourself some tools. That is what I'm going to be looking at to gauge when it is time to start looking a little bit more cautious, neutral, bearish, etc. But for now, I think the party rages on for the bulls. If I'm wrong, I'll manage risk appropriately. Thanks, guys, for watching, and we'll see you back in the next one.